My name is Bernhard Schwetzler. This is part 2 of our tutorial about terminal value calculations in corporate valuation. In part 1, we have introduced the famous Gordon-Shapiro model. In part 2, I would like to show you an extension of this Gordon-Shapiro model and some sanity checks that prove to be very helpful for finding reasonable growth assumptions for the terminal value calculation. Okay, so let's start by looking at the extension. Yeah, the extension of the Gordon-Shapiro model is a model developed by Bernhard, Kohler and Wessels in their famous corporate valuation book. And this extension allows to split the rate of return on the assets into the ROIC of the old assets in place and the ROIC of the newly acquired assets by the retention. And this model is called the value driver model. And you should remember that the Gordon-Shapiro model, the plain Gordon-Shapiro model, works with the assumption that all assets have the same ROIC, the same rate of return, and the extension is now we can split the rate of return between the old and the new investments. And the result of this split is that the growth rate, and of course by doing so our valuation formula, is only depending on the rate of return of the newly acquired assets, and the rate of return on the old assets, which is supposed to stay constant, of course, does not have any impact on the growth rate. So here's an example. Yeah? So we split the ROIC into the rate of return on the old assets on 10%, and the new assets have a higher rate of return, double of the old, that's 20%. And now this calculation just shows that the growth rate of our NOPLAT and the growth rate of our free cash flow is driven by the 20% RONIC, the rate of return on our newly acquired investments, and not on the ROIC on the old ones. Yeah? So we start again with 100 assets earning a rate of return on 10% and yielding a NOPLAT of 10. Again, 40% is retained and 60% is cashed out, so we have a free cash flow in the first period of 6. 40%, 4 out of the 10, is retained, and we have new assets now of 4. Note that these newly acquired assets have a rate of return of 20% now, yielding additional earnings of 8, whereas the old assets stay at their old ROIC of 10 and deliver constant NOPLAT of 10 every period. So now we have 0.8 plus 10, 10.8, 60% cash out ratio yields then 6.48 as a free cash flow. And if we compare now the growth, or if we calculate the growth rate of our free cash flow, then we see that the growth rate here is 8%, and it is 40% is the retention rate, times the rate of return on the newly acquired and not on the old assets, which is here 10% and the old one is, 20% and the old one is 10%. Yeah? So again, of the 10.8%, 10.8 NOPLAT, 40% is retained and used for acquiring new assets, that's 4.32, and that yields new assets in total of 4 in the first period and 4.32 in the second, in sum of 8.32. Again, earning a rate of return of 20%, that yields additional NOPLAT of 1.664, combined with a 10 of coming from the rate of return of the old assets, yields NOPLAT of 11.664, and that again yields a growth of 8%, which is again driven by the RONIC and not by the ROIC. So the point that I want to make with this slide here is, this is just to highlight that the rate of return on the newly acquired assets is important for the growth rate and not the one on the old assets ROIC. So that offers a nice extension of the Gordon-Shapiro model, because now we can work with different rates of return on newly acquired and on old assets. Usually we might assume, in opposite to what I've shown you as an example, that the newly acquired assets show a lower return than the old ones, just to be able to highlight some decreasing business cases and decreasing growth opportunity in business cases. So the formula looks very similar to the classic Gordon-Shapiro formula. The only thing that is different is that we replace ROIC by RONIC. Yeah? You see here again the version of replacing the retention rate by the ratio of G over RONIC, and here the version where we replace the growth rate by the product of retention rate and RONIC. Yeah? So that's the only difference. The mechanics are alike. And now we can use this formula to make some inferences on what factors actually have an impact on the terminal value in our corporate valuation setting. Yeah? Of course, for obvious reasons, NOPLAT plays a major role. The higher the NOPLAT, the higher the value is. Here, the WACC plays a role, the RONIC plays a role, and G plays a role. What is now important in this slide is that we cannot say anything about the impact of growth upon the terminal value unless we know the relationship of RONIC and WACC. Yeah? So the difference between RONIC and WACC is simply the excess rate of return, or as we may say, the spread, that is the rate of return that is above the cost of capital. And the impact of growth on value crucially depends on whether RONIC is equal, greater, or smaller than WACC. Yeah? So let's start with the first case where we set the two equal to each other. Yeah? WACC is equal to RONIC. That means with the newly acquired assets, the firm just earns its cost of capital. And then we can easily show by replacing RONIC in this formula by WACC, extending the equation a bit, that G is actually canceling out of the equation. And that means that G does not have any impact on the terminal value, which makes perfect sense if we remember that obviously our additional investments, our newly acquired assets carry obviously an excess rate of return of 0, and that means that they carry a net present value of 0. And the idea is it doesn't make a difference on whether you grow fast or whether you grow slow or whether you grow at all. If you just earn your cost of capital with your newly acquired assets, then obviously you won't create any value. Even worse, if WACC is greater than RONIC, then obviously our newly acquired assets carry a net present value that is smaller than 0. And then, of course, the impact of higher growth is obviously negative on the value, because the more we grow, the more money we burn, and the lower the value is. So actually, growth is only implying additional value to the shareholders and the investors if we have a situation where the rate of return is higher than the WACC. That means the firm earns a positive excess rate of return on its newly acquired assets, and the newly acquired assets, by the same token, carry a positive net present value. So when looking at these formula, we can tell the requirement that is necessary that our earnings and our free cash flows grow without any asset growth, and that is that RONIC is converging infinity, because if so, then our NOPLAT and our free cash flow grows without any asset growth. So now I would like to show you a sanity check that is very, very helpful if applied on valuation reports, especially in the terminal value setting. So the idea is that we use this triangle here, yeah, that we use this triangle between growth rate, rate of return, and retention rate by calculating the retention rate for the first year in the terminal value calculation, or, which is the same usually, the last year in the phase number 1. Yeah? So we know here in phase number 1 the earnings figure of the last year and the free cash flow, and the difference between the two is the absolute amount retained divided by the NOPLAT. That is the percentage ratio, the retention rate that is set aside to acquire new assets. This can be applied and calculated based on the valuation report. The second step is we look into the valuation report and look for the growth rate that is assumed to hold for the terminal value calculation, and then we combine our growth rate with our calculated retention rate to come up with the implied RONIC figure derived out of this combination. And then we compare on whether this implied RONIC figure is equal, greater, or smaller than the WACC. Yeah? This is just a sanity check that we might perform. So I have here again a slide that shows actually that the basic idea is to combine retention and return to a growth factor. And the important message of this slide here is that we actually talk about a two-dimensional problem. Yeah? Usually people are quarreling around in the negotiations and corporate valuation about the appropriate choice of growth. And my suggestion would be that we replace the discussion about the appropriate rate of growth by a discussion of appropriate combinations of retention rates and returns yielding a certain growth. That is, we actually have here a two-dimensional problem instead of the one-dimensional discussion that we face quite frequently in practice. Here is an example. Yeah? So we look at the growth rate of 4%, yeah? Here and here. And the idea of this graph is that, of course, there are many combinations of retention and growth that may yield, of retention and return that yield a growth rate of 4%, and not all of these combinations are creating value for the shareholders. So here you see the first combination is a positive one for the shareholders. We have a rather low retention rate, 25%, and a rather high rate of return of 16%. Both combined yield a growth rate of 4%. If we assume a WACC of 10%, then this type of growth of 4% is creating value for the shareholders because we earn an excess rate of return here of 6% above our cost of capital. The second part of this slide is the same growth rate, but now derived based on the different combination of retention and return. 50% retained at 8% rate of return is also yielding a 4% growth rate, but you can easily verify that in this case the rate of return is below the WACC, and that means that in this particular case our assumptions destroy value because we have a negative excess rate of return, a negative spread of 2%. So you see that both growth rates are equal to each other, but both are created by significantly different combinations of retention and return. And so you see that the growth rate itself alone is not telling us whether we are creating or destroying value by growing. So here are some examples how to use the sanity check that I have just mentioned. Yeah? Let's presume that this is always the profits and loss statement and the derivation of our free cash flow in the first year of our terminal value calculation. So you see here we have our EBIT projections, we have taxes on the EBIT, we have our NOPLAT. And here you see now our retention in total. Yeah? You see that this is the way from NOPLAT to free cash flow. And the idea is that our valuation report tells us that we have a growth rate of 3% to infinity. And now our sanity check is simply calculating the retention rate, combining it with the growth rate, and then double check on whether our rate of return is greater, equal, or smaller than our WACC. And our WACC in this example is supposed to be 13%. I add this here, yeah? So, looking at the figure here, when we try to calculate our retention, then you see that our free cash flow in this case is greater than our NOPLAT, which would imply a negative absolute retention, and of course by the same token a negative retention rate. Looking at the figures here, you can easily tell that a negative retention and a negative retention rate in an infinite time frame is obviously not very reasonable. Yeah? And if we look closely where this negative Q, a Q smaller than 0 is stemming from, then we see obviously that here our net investments are equal to 0. That is, we just have a capital expenditure that is equal to the depreciation. But the reason for our negative retention rate is this one here, that we have a change, an increase in the current assets of 1 million roughly, but an increase in our short-term liabilities, non-interest-bearing liabilities of 7.6 million. And so we have a delta net working capital of minus 6 million, that is here yielding the result that our free cash flow is higher than our NOPLAT. So a negative delta net working capital may happen from time to time. So you see that here. We find obviously suppliers, for instance, or customers providing us with 7.6 million euro, whereas we just need 1 million to cover the increase in our current assets. And this may happen once, but obviously it is not reasonable to assume that this is happening every year from now to infinity. And so obviously that yields the result that it is reasonable to assume in an infinite time frame that obviously the delta net working capital in this calculation here is negative. That means that our debt and equity holders jointly have to invest into a growing net working capital basis. So this is obviously not reasonable. Yeah? Second example, same NOPLAT, free cash flow is again higher than the NOPLAT. You see that we removed our unreasonable assumption by at least assuming that the delta net working capital in this example is equal to 0. That is, we have 7.6 million increase in current assets and at the same time 7.6 million increase in current liabilities. That is, delta net working capital is equal to 0. But this time our negative retention and negative retention rate is stemming from another mistake here, that you see that our depreciation exceeds the capex by 4 million. And if we would perpetualize this in our calculation, then obviously that would mean that every year we always just reinvest 4 million less than our depreciation, and that would mean that obviously our asset base would decrease down to 0 and would be vanished after some years. So this is also not reasonable here. Yeah? So a Q smaller than 0 is not reasonable in any of these cases in an infinite time frame. So the third case here is we have again a NOPLAT of 34 million, and now we have a free cash flow of also 34 million. Now looking at the absolute amount of retention, you see that our capex and our depreciation are equal to each other, and our delta net working capital is also equal to 0, and that means that no new additional assets are bought by setting aside a part of the NOPLAT. That means that in this case here we have no asset growth, and combining this with a growth rate of our free cash flows and of our earnings, this is also not very reasonable, because that means that we have the case of growing NOPLATs or growing earnings and growing cash flows, but stable assets, and that would again point into the direction that the rate of return would converge against infinity. So this is also not reasonable, a retention rate of 0 and a growth rate of 3%. So the fourth case now starts with a free cash flow that is lower than the earnings figure, which is finally reasonable. Yeah? You see here we have capex exceeding depreciation by 2 million, and we have here a negative delta net working capital. That means that our current assets exceed the increase in the short-term liabilities, and so our delta net working capital is negative. And that means that our free cash flow is smaller than our NOPLAT, and that means that we have a Q, a retention rate that is greater than 0. And now we are finally able to calculate it. So our Q in this example is here 34.7 31.385 minus 31.018. This is the absolute amount retained, and then divided by 34.385. This is then the percentage as a retention rate, and in our case here, it is 9.79%. Yeah? So you see it's a rather low retention rate, and now if you combine it with our growth rate, we calculate here our growth rate being 3% divided by our 9.79% retention rate is then the implied ROIC, or the implied RONIC, and the result here is that it's roughly 30.6%. Yeah? So again, looking at our WACC of 13%, we see that obviously with a very low retention, we establish a significant growth rate of 3%, and that implies that our newly acquired assets are really carrying a significant excess rate of return and providing us with a real additional value. Yeah? Whether this is reasonable or not obviously depends on our industry expertise, on whether we are judging this as possible, that with a very low retention of 10%, we will still be able to create a growth rate of 3%. Then finally, the last example here is, again, 34.385, our NOPLAT. Free cash flow is now significantly lower. You see that our amount of retention is going to increase, and so does our retention rate. So the retention rate in this case is here 34.385 minus 26.685 over 34.385, and that's now already a significant fraction of NOPLAT that is set aside, that it's 22.4%. In order to create a growth rate of 3%, and now combining this with our growth rate to get our implied RONIC, then we have 3% growth rate divided by 22% retention. That yields an implied rate of return of 13.4%. And you see now it's just roughly equal to our WACC, yeah, of 13%. So you see that if we have a very low retention rate creating a growth of 3%, then this implies a very high rate of return on the newly acquired assets. And of course, if we need more retention to get the same rate of growth, then obviously the rate of return on the newly acquired assets is going to decrease to 13.4%, and you see that this is already very close to the WACC. So, thank you for your attention.